Ever notice how everything got more expensive and worse at the same time? Your dentist suddenly pushes procedures you've never heard of. The vet spends 12 minutes with your dog, but the bill has tripled.
Many of us will do just about anything for our pets, but some owners say the costs at the vet are getting out of control.
At the nursing home where you left your parents, there are fewer nurses on shift, and deaths are quietly up 11%.
As a reminder that Reformation is private equity owned. In July of 2019, Reformation sold a majority stake of their business to a private equity firm called Permira.
Most people blame inflation, or greedy corporations, or just the times we live in. They are wrong. Behind all of this is a small group that operates in the dark, a closed club of investors, quietly rewiring your everyday life for profit. Private equity. To most people, that's just a boring phrase from the news. In reality, it's the machine behind your clinic, your vet, your parents' nursing home, and the doctor you think is in charge.
Private equity.
Private equity.
Private equity.
In the last decade in the US alone, private equity funds bought around 7,000 dental practices, 5,000 vet clinics, and roughly a quarter of all hospitals. For the original owners, it's a jackpot. For everyone else, it's the start of a slow collapse. If you thought the owner of your clinic was a friendly doctor next door, sorry. The real owner is a fund managing trillions of dollars. By the end of this video, you'll know how the machine works and how an old financial trick turned doctors into salespeople and patients into collateral. Let me show you. Imagine you run a small clinic. It's doing okay. Some savings, some equipment, a steady flow of patients. A private equity fund decides it wants to buy your clinic. There is a fund, a bank, and your business. The fund goes to the bank and borrows most of the purchase price, using your clinic as collateral. The bank sends the money, the fund buys the clinic, and then the loan is pinned to the clinic itself, not to the fund. From that moment on, a big part of the clinic's income no longer goes to staff or equipment. It goes to the bank to pay off the fund's loan. That's a leveraged buyout, buying a business mostly with borrowed money, then making that business pay the loan back. This is the core move behind most private equity deals. And once you see it, everything you feel on the surface starts to make sense. Now let's see how it looks in real life. You go to the dentist with a mild toothache. The doctor examines you, leans back and says, "You need 7 fillings." You are shocked. 7? But he insists. He sounds confident, so you agree and he drills. Later, it turns out 4 of those 7 teeth were perfectly healthy. Sounds paranoid, right? It isn't.
I had an ex-assistant who worked for one of the corporates. He was a treatment plan coordinator, and he said what his job was to find $1,500 worth of work on every new patient.
In the US, investigations into dental chains owned by private equity found they were literally drilling healthy teeth in children. Not because the kids needed it, because the numbers did. The dentist doesn't just have patients, he has a daily sales quota, a fixed number of fillings per day, per chair, to keep the dent machine satisfied. He's not just a doctor anymore, he's a filling salesman with a target. Same story at the vet.
In the past decade, private equity and corporate buyouts of vet practices has increased from 5% to 25%, and it's even more aggressive when it comes to like specialty care. Today, corporations control 75% of specialty vet clinics and emergency hospitals, basically all the places that you would go if your pet is sick. And like I said before, Mars, literally the candy company, is dominating this space.
Your dog isn't even well. You're worried. You walk into the clinic. The vet spends exactly 12 minutes examining your dog, because that's the regulation now. Then he orders 3 tests, each one around 3 times more expensive than at an independent clinic. Why? Because somewhere above him, an experienced specialist was replaced by yesterday's graduate. Lower salary, higher profit. Questions take time. Tests bill instantly. The less the vet thinks, the more the system earns. And in nursing homes, it's worse. They used to have 1 licensed nurse for 20 to 30 residents. Now, it's often 1 for 60. Researchers from leading US business schools studied around 18,000 nursing homes. Their conclusion was chilling. In facilities owned by private equity, the risk of dying is about 11% higher. On a spreadsheet, it's a tiny percentage change. In real life, it's your mother waiting too long for help because the only nurse on shift is covering 3 corridors at once. People feel this. After a fund buys in, patient satisfaction drops 10 to 15% within the first year and a half. You can't always explain it, but you sense that something's broken. The question is, why is the system built this way in the first place? Underneath all of this is debt. We already saw how leveraged buyouts work. A fund buys a company using 80 to 90% borrowed money. In a healthy business, that might equal 2 to 3 years of profit. After the fund arrives, that can jump to 8 to 10. The company turns into a shell. From the outside, it looks alive. Lights on, staff working, patients coming in. Inside, almost every spare dollar is wired out as interest. No money left for staff, equipment, or real improvements. Now add in scheme number 2, sale-leaseback, also known as sell your walls. The fund buys a supermarket chain. Those supermarkets own their buildings. The real estate is the company's backbone. The fund sells the buildings to an outside investor, takes the cash, books a profit, and now the supermarket rents its own walls every month, forever. Short term, the fund looks brilliant. They unlocked value. Long term, the company lost its assets and gained a permanent bill. There is a real example: the Marsh supermarket chain in the US. A fund bought it, sold off the real estate, and pocketed the money. Within 3 years, around 20 to 30% of stores closed. To shoppers, it just looked like another failed chain. Behind it was a spreadsheet that cared more about a quick payout than whether those stores could survive. So where do funds get the money to play this game at scale? Guys, I make videos every week for this channel, and honestly, growth could be better. But what motivates me is literally just a few likes I see on each video. So please, if you really like this video, hit the like button, leave a comment, and subscribe. It really helps me out. My goal is to help you see the real truth in a world that keeps shifting. Let's continue. For about 15 years, money was almost free. Central banks kept interest rates low, loans were cheap, credit flowed like a river. Private equity funds borrowed trillions and went to shopping. Dental clinics, vet, hospitals, nursing homes. One by one they were absorbed. From 2015 to 2025, private equity's share in American healthcare grew from around 10% to roughly 25%. Every fourth clinic now belongs to a fund. Today, private equity funds manage around $12 trillion. That's on the same scale as all the tech giants combined. How do they make money? Not mainly by building good companies, by fees. Most use something called 2 and 20. 2% of all assets every year, no matter what, plus 20% of profits if things go well, so fund managers can get rich, even if the companies they own are burning. And they've done whole business for decades. Average ownership is 5 to 7 years. They're not planning for 2050. They're squeezing what they can right now and selling on. All of this worked while money was cheap, but now the bill is due. In 2026, trillions in private equity debt. It's what insiders call the maturity wall. Old loans must be repaid or refinanced. Banks look at over-leveraged companies with flat earnings and rising risk and quietly say, no. Defaults on these loans have climbed to levels not seen since 2020. Funds start fire sales, dumping companies at reduced prices just to get out. When banks refuse, another player steps in. Private credit. Non-bank lenders who offer loans when banks won't. This market has exploded to around $1.5 trillion, more than the GDP of countries like Spain. But their rates are brutal. 8 to 12% a year, roughly double many bank loans. So funds already drowning in debt run from the banks to private lenders. They refinance at double the price to keep the game going a bit longer. It's not rescue, it's fighting fire with gasoline. The companies underneath are crushed by debts they can't service. And now comes the most cynical move. Regulators and lobbyists talk about democratizing investment. In plain English, letting ordinary people put retirement money into private equity through accounts like 401ks. It sounds like they're letting you in on an exclusive opportunity. In reality, they're looking for the last buyer. Research by Oxford professor Ludovic Philippou shows that after fees, these funds on average don't reliably beat simple stock indexes. But in private equity, there is a twist. Public stocks crash on screen. You see the volatility. In private equity, prices are often drawn by manager. Losses can be smoothed, hidden, and delayed. They call it volatility laundering. On your statement, everything looks calm. In reality, risk is piling up behind the glass. So when the system finally cracks, who pays? Private equity isn't just a few villains in suits. It's what happens when capitalism is reduced to a spreadsheet. In that sheet, there are no cells for compassion, quality, or safety. There is one metric: return on capital. If you think this is only about healthcare, it isn't. It's in software, restaurants, insurance, anywhere someone realized they could buy, leverage, strip, and sell. Yeah, you can personally fix a $12 trillion industry, but you are not completely powerless. Consumer awareness is pressure on the system. When a clinic feels off, ask, who owns this now? Look at the name on the paperwork. Is it still a real person or a faceless group with dozens of locations? If it's a fund, you already know what the spreadsheet is optimizing for. Whenever you can, support the people who are still actually there. Local businesses, real neighbors. In 2026, funds are slamming into their maturity wall. The cracks are already visible, but until it breaks, it will keep squeezing you. So the next time a bill feels insane or a service suddenly gets worse, don't just blame inflation. Ask the only question that really matters: who owns this? Thanks for watching. If you enjoyed this video, hit like and subscribe for more content. See you at the next one.